A common problem I find when reviewing investment portfolios for new clients is that there's an over-reliance on dividend-paying stocks or funds. The theory being that you can rely on dividend income in retirement to provide all your retirement income without having to sell down any of those units or shares. Now, it sounds good in theory. The underlying capital remains untouched and sits there throughout your retirement. But the problem is when you start factoring in inflation, what happens to the real value of those underlying shares once inflation's factored in? So in this video, I'm going to explain why you shouldn't rely on dividends to provide your retirement income and what the better solution is. My name's Carl, and I'm a registered financial advisor and chartered financial planner. Welcome to the channel, and in these videos, I'm trying to get across messages that will help you become financially independent so you can build wealth and really enjoy your life. So let's look at dividends in a little more detail. The Association of Investment Companies, AIC for short, have compiled a list of investment trusts that have consistently increased their dividends for 20 years or more in a row. Now, they call this list their Dividend Heroes. And at the top of the list currently at the time of recording is an investment trust called the City of London Investment Trust, which has increased its dividend for 57 years in a row. Now, you may be thinking, what is an investment trust? Well, an investment trust is still a fund and very similar to the more common funds found in your pension and ISAs, those being the open-ended investment company, or OIC for short, or unit trusts. But there's a few differences. So the main difference with an investment trust is that it's closed-ended, which means the actual shares in the investment trust are traded on an exchange. And those shares won't always reflect the underlying value of the holdings, because sometimes the investment trust itself might be more popular or be out of favour, which can create a premium or a discount. Whereas with your open-ended funds like your OIC and your unit trusts, these funds will just close units. These will just remove units if investors are selling or add units if investors are buying. So the unit trusts and OICs usually always reflect the value of the underlying holdings. Another big difference with investment trusts is that they are allowed to keep back up to 15% of the income the fund earns. Whereas with your OIC and your unit trust, they have to distribute all income that the funds earn. So with the investment trust, because they can keep money back, they can then use this money to increase dividends in future years if the market's perhaps not in a good place. Now, dividend investors will focus on something called the dividend yield. So a dividend is a share of the profit a company makes. And the yield is a way of comparing different types of income from different investments against each other. So to get the dividend yield, you take the dividend and divide it by the share price, which is going to give you a percentage number that you can compare against different types of investment. Let's take property, for example. If you're an investor in property, you'll be receiving rental income. To get the rental yield, you'll take the rent and divide it by the property price. So now you can see you've got another percentage that you can compare against dividend yields and see what gives you the best income. Also, cash savings will earn interest. So if you take the interest earned, divide it by the cash you've saved, that will give you a cash yield. Again, you can compare it against the other types of investment. Now, the yield is going to be a very important number when it comes to dividend investing. And if you have an investment or a share that is offering you a very high dividend, it could be that you're going to have to pay a high price for this, which is going to expose your underlying investment to potential losses if you're coming in at a higher price. So let's have a look at the top 3 dividend heroes. Now, first up, we've got the City of London Investment Trust. Now, this trust focuses on UK listed companies. And you can see from the top 10 holdings, it includes the likes of Shell, HSBC, and BAE Systems. Now, at the time of recording, the dividend yield was around 5%, meaning if you invested £1 million, it could provide you with a yearly income of £50,000 without having to sell shares in the trust. However, what we need to focus on is what's happened to the underlying capital over the last 10 years. The price of a share in the fund has gone up 7.2% over the last 10 years. So you may be thinking, well, that's not too bad. Not only have you had all your dividends, you've also seen an increase in the underlying capital. But have you? If we factor in inflation using the retail price index, your underlying capital has actually been eroded by around 42%, meaning your original £1 million is now only worth £580,000. Nearly half of your purchasing power has been destroyed over the last 10 years. What if you still have another 10, 20 or 30 years of retirement to go? So next up, we have the Bankers Investment Trusts in second place. Now, this investment trust has a much more global focus, and its top 10 holdings include the likes of Microsoft, Amazon, Visa, and Toyota. The share price has achieved a return of 97.18% over the last 10 years. So already a much better return than the previous investment trust due to it being much more globally focused rather than just focusing on UK stocks. So in this scenario, your underlying capital has nearly doubled over the last 10 years. But it hasn't doubled in real terms, has it? Because we need to factor in inflation again. So when we factor in inflation, we can see that the trust still has impressive returns of 47.3% after inflation. So it's still looking positive so far. However, at the time of recording, the dividend yield is 2.28%. So on a £1 million investment, you would currently only be able to generate around £22,800 a year in income, which is much less than the previous investment trust we looked at. And if you needed more income, you would need to start selling down shares in the trust. So rounding off our top 3 dividend heroes is the Reliance Trust, which is another trust which focuses on global stocks. Now, it has very impressive share price returns over the last 10 years, earning over 170% before inflation and 120% after inflation. So even after factoring in inflation, you would have still doubled your underlying capital over the last 10 years. This particular trust does have a large exposure to technology stocks, which have done pretty well over the last 10 years, which is why the share price has done so good. However, at the time of recording, the dividend yield was just 2.08%, meaning a £1 million investment would generate an income of £20,800 a year. Now, according to the Retirement Living Standards research, a comfortable retirement requires an income of £31,300 per year for a single person and £43,100 per year for a couple. So there are a couple of problems with solely focusing on dividends as your income strategy in retirement. Firstly, if the dividend yield is high, it may be the case that the underlying shares that the fund has invested in are not rated or valued very highly. So whilst the income you earn from the investment might be higher, your underlying capital might suffer losses or be eroded by inflation. Alternatively, if the fund has a good underlying investment strategy and returns on the underlying shares are good, you might find you start off with a much lower dividend yield, meaning the income produced from the fund is much lower at the start. And of course, dividends are not guaranteed. Now, we have gone through and looked at a couple of dividend heroes that have raised their dividends for a number of years, but there's no guarantee this will continue. Funds could quite easily reduce the level of dividends they pay or stop them altogether if market conditions turn against them. But don't get me wrong, dividends are very important in an investment strategy. Let's look at the returns of the FTSE 100 share index, for example. The return over the last 10 years, if we just focus on the FTSE 100 price, is just 21.85%. But if we add in the dividends produced, it takes the total return of the FTSE 100 share index to 79.05%. Now, this is all because dividends reinvested can buy more units in the same fund. So the better approach to take when trying to organise your retirement income is to focus on total return. The underlying share price plus the dividends reinvested. Because remember, at the end of the day, you want and need inflation-beating returns. Don't worry about having to sell down units, because if the performance of the underlying units is better, you won't need to sell down as much. Getting inflation-beating returns means you're protecting your purchasing power. And that's what money is at the end of the day, purchasing power. If you focus on dividend-paying stocks or funds, you're restricting yourself to certain areas of the market. Because the better dividend payers tend to be funds or companies that are larger, more established, and so not concerned about growth as much. They tend to be shifting all of the profit that the company makes back to investors, whereas a growing company will reinvest much more of its income to help grow the share price over the longer term. So you want to be able to diversify your investment strategy and capture the global market return, not restrict yourself. You can even do this with one fund nowadays. If you look at the MSCI AC World Index, for example, this index, which captures the global market return, has achieved a return of over 539% over the last 20 years, which is 5 times the rate of inflation. So you need to be focused on inflation-beating returns, not just income. Remember, a £1 million investment today generating 5% income, perhaps for a dividend yield, will give you £50,000 per year. But that underlying £1 million is not going to be worth £1 million in 10 or 20 years' time if returns don't beat inflation. So you're just not going to be able to buy as much in the future if you've not beaten inflation, and your kids are not going to be very happy with their inheritance if it's been ravaged by inflation. Now, I hope you found this video useful. Please don't forget to subscribe to the channel if you haven't already, because we've got lots more videos coming soon. Till next time, take care.